we close out July, the market's banked on a rate cut. It never came. The clearance rates have ticked up, but listings have fallen off a cliff, and end of financial year spending hit record levels while confidence collapsed. The media shouted a boom, but the buyers, they stay calm. Prices have slipped, stock has vanished, and now spring is loading. G'day folks, it's Matt Hayson here with The Word, looking at everything impacting Sydney's property market this weekend. This week it's about reflection because July, it's been a wild one. We had a full-blown hype around a rate cut that never arrived. Commentators were loud, but the data was quiet. The media pushed clearance rates were surging. Some even said underquoting was back in fashion. But when you cut through all of that noise, the real story was supply, not surging demand. Now, according to SQM research, Sydney's actual clearance rate through July consistently landed between 52 and 55%. Not exactly boom time numbers, but prices, they dipped too. Stock tightened and Domain showed a 20% drop in inner west listings compared to July last year. And SQM reported a 15% fall in auction volumes citywide. So yes, clearance rates look better, but they look better because there was less to clear. And here's the real contradiction. End of financial year spending hit a record 9.1 billion, but consumer confidence has been locked in pessimistic territory for 3 straight years. And at the same time, we've seen record small business closures, a 30-year low in productivity, and more than half of the country now dependent on government income. This isn't a booming economy, it's a wobbly one. So now we head into August, and once again, the market is betting big. There's a 97% chance of a rate cut, but let's be clear, this is not the kind of rate cut that will fuel a property surge. It's not rocket fuel, it's more a defibrillator. And sellers, they're holding out for that 25 basis point to magically add 10% onto their price. Well, that's wishful thinking. On the ground, the truth is sharper. Buyers are active, but they're not reckless. They're doing the work. When price aligns, they move. But when we see prices even 5% too high, that's when we see campaigns stall. We've seen it. Auctions postponed, price guides being pulled back, campaigns quietly withdrawn. This is a market for precision, not for panic. So let's zoom out a little bit. Since 2021 to now, Sydney prices across most of our regions have grown by an average of 6%. We've tracked it closely. Yes, some homes continue to set benchmarks, but the idea that we're riding a wave of explosive growth, it's not backed up by the numbers. And now though, the RBA has egg on its face. They held off cutting in July, as we know, waiting for proof. Well, it's here. Inflation's come down again to 2.1%. Unemployment climbing to 4.3%. The economy isn't running hot, it's stalling. Markets are betting again. They're betting big on this August rate cut, and some are even whispering a 50 basis point cut. Yet still, we're heel rating this on the CH Market Mood Meter as a 6.8 out of 10 market. Steady, stable, real. Buyers are here, they're serious, but they're not chasing the market. And sellers who understand that and who align with the rhythm of the market, they're the ones who are getting the rewards. So now we're seeing stylists are booked out, our photographers, a flat chat, and spring campaigns, they're being locked and loaded fast. Now, if a rate cut comes, which we do expect, it'll be met with a wall of fresh stock, and that should keep conditions fairly well balanced. So as we turn the page from July and into August, don't buy into the noise, buy into the truth. This is a market that rewards alignment and punishes assumption. Now, with all of that said, we have some incredible property available this weekend. We'll keep delivering the truth so our clients can make better decisions, and I'll catch you all next week.